Supply and demand. Absolutely everybody is talking about it, including this hedge fund manager that explains exactly how he uses it in an interview. But we'll get to that in a little bit. So why should we learn supply and demand in the first place? To understand that, we have to dive deeper into the core concepts of why the market moves. Why does the market move in the way that it does? The only way a chart will move up is if there's more buying pressure than selling pressure. Now, I know what you're thinking.
Oh, Trading Lab, that is so obvious. Why are you wasting our time and even telling us this?
Well, lady, I was about to get to that. Because a lot of people don't really sit down and think about the basics. A lot of people will watch a YouTube video, get told to draw some fancy rectangle on their chart by a random trading guru because they say it works. But in reality, the viewer has no idea why it works. But not my viewers, you guys are smart. You actually want to learn.
You know how long I've been waiting for this? Woo, I'm about to make a name for myself here.
So look at this picture. Here we have all the buyers and sellers in the market. The red represents the sellers winning, the green represents the buyers winning. When you have a lot of sellers, like in this area, price will drop fast and sharp. Something like this, because sellers are in complete control. As price starts to go down, more and more buyers will start to fight against the sellers, slowly gaining back control. Now, as more and more buyers are entering, this can cause little pullbacks on the chart, but the chart's momentum is still overall bearish. Price will only fully reverse once there's a large majority of buyers compared to sellers, like in this area. And once that happens, there will be a fast, sharp move to the upside, and then the whole process repeats itself, going on forever in the future. Now, why am I telling you this? You see, one day I got bored and read a financial article. Yeah, I know. I read financial articles when I'm bored. I'm a nerd. But on a rainy afternoon, I was reading an article that interviewed a hedge fund manager and how he looked at the market. And he said something that really stuck out to me. But when reading this financial article, this hedge fund manager said something that really stuck out to me. You need to focus on who is on the other side of the trade. Whenever you buy a position, there's always a seller on the other side of the trade, which means there's always someone who thinks the chart is going to go in the opposite direction than what you think. Now, this is a very, very important concept to understand. If you're always buying from someone who is selling, would you rather buy from a good trader or a bad trader? When you're buying a position, you want to be buying from someone who is inconsistently profitable. If you start thinking like this when trading, it'll change the way you take trades. If you don't know where these profitable traders are selling, you might just be one of those bad traders they are selling to. But how do we know where these profitable traders are buying and selling? Going back to this chart, the only way we know a large group of sellers or buyers are in complete control is if there's a sharp move. So take this chart for instance. When I look at this chart, I'm not trying to predict the future. I'm just trying to look at where the majority of buyers and sellers are. Here, the chart had a sharp downwards move from this point, meaning there were way more sellers than buyers from this point on. In other words, an area of supply. Now, you may ask, how do we know there are more sellers? If there wasn't drastically more sellers at this point, price would just continue to move sideways here. But that doesn't happen. It moves sharp to the downside. Here, the opposite is true. There was a sharp move to the upside, meaning there is way more buyers than sellers, or an area of demand. Another way to look at this is like this. You know the company Costco? I love that company. You can buy anything from there. But what is Costco's business plan? They buy a large amount of inventory in bulk at a cheap price. Then what do? They sell it to a retail buyer for a higher price. The only way Costco can make money is if they sell to a quote-unquote bad buyer, or someone who is willing to pay more than what they did for the product. You should look at trading the exact same way. If you're Costco, where are you buying your inventory in bulk? Obviously at a low price. Where are you selling to a retail buyer? At a high price. Now, remember that statement I made before? In order to be a winning trader, you have to sell to a losing trader. Now, when you look at this chart, where will the losing trader be buying? A lot of retail traders will buy in this area, maybe because they see some momentum building up, an indicator tells them to enter, or whatever the reasoning is. But they are missing a very important key point. Supply exceeds demand in this area, meaning there are drastically more sellers than buyers here. Only a bad trader would buy when there are more sellers. So when looking at this chart, you should be asking yourself two questions. Where are the major points where there are drastically more buyers and sellers, and where are the bad traders buying and selling? If you answer these two questions correctly, you will be a profitable trader. So where are the majority of buyers and sellers? Well, we can see from this point on, there was a sharp move to the upside. This could only happen if there's drastically more buyers than sellers. So we mark the beginning of this move. Now, where there are more sellers than buyers? Here we have a sharp downwards move, which could only happen if there were more sellers than buyers. So we mark the beginning of this move. If the chart looks something like this, we don't have a clear area of supply and demand because there were no sharp moves. Sure, the chart moved down from this area, but that just shows there are slightly more sellers than buyers, which we're not really interested in. We want to know areas where there are drastically more sellers than buyers, which we can only tell if there's a drastic sharp move. Please take note of this because it's very important. Then we have to ask the final question. Where are the bad traders most likely to enter and exit? A bad trader is going to sell when there are more buyers than sellers. So we have our supply and demand areas. Wait for price to come to our demand. We buy from the retail trader who is inconsistently profitable. Set our stop loss below the area of demand. Set our take profit at the area of supply. Watch the trade play out, price eventually hits the area of supply, and we sell to the inconsistently profitable trader who buys up here. Since you made it this far in the video, here's 2 extra tips to make your supply and demand zones even stronger. First trick, you want price to slowly approach your supply or demand zone. For example, if price goes up aggressively and you draw your demand zone like normal, you want price to slowly come down to that demand zone when it returns. The slower and the more steady, the better. If price returns to your zone like this in a very aggressive and sharp manner, you would not enter into this trade. You want price to slowly come down to your zone. This tip in itself is a game changer. Tip 2, you want a fair value gap at the beginning of the move. So remember how I told you mark your zone off the previous candle before the big aggressive move? You want a fair value gap connected to that candle. So here you can see price jumped up super fast after this candle and created an imbalance right here. This is exactly what we want. If this happens, it'll improve the chance of your zones working even more. If something like this happens when price just slowly creeps up after the candle, this would not be good. The zone still might work, but it has a way higher chance of working if it has a fair value gap like this example. So here's a final recap of the perfect supply and demand trade. Here we have a strong move to the upside starting from this candle. So we mark our demand zone. Notice how there's also a fair value gap connected to this demand zone, giving us insight there are way more buyers than sellers in this area. We wait for price to see what it does next. A similar thing starts happening up here. Price is starting to reverse with a strong downwards move. This is our area of supply. This move also has a fair value gap connected to it as well, so that's good too, which is showing there are a lot more sellers than buyers up in this area. Perfect. Next, we want price to slowly come down to our area of demand, slowly being the key word. Once it hits our zone, we enter, set our stop loss below the area of demand, and set our take profit at the area of supply. And just like that, you got a winning trade. Start looking for areas where bad traders are buying and selling, and it'll change the way you trade forever.